How's it going, Urshan students? We're going to go over this personal finance portion here about insurance, and to uh, I just want to go over some of the personal insurance. It's not a comprehensive guide, but just give you some verbiage and verbiage about what's going on. So first off, we're going to start with health insurance. In America, this is very important, but it's also very costly in the way that we set it up. But we're not going to debate the best way to offer health insurance in a country, but we will go over what's happening here in the United States. So first, the idea is to protect you or your family in the event of a medical need or to help mitigate medical needs. For example, if most insurance gives you or actually requires you to go see a physician for checkups and that sort of thing to help mitigate future medical needs. You're going to pay what's called premiums. Now, a premium is your monthly payment that you're going to make in order to receive this health insurance benefit. With the rising cost or the crisis of rising costs of health care in the United States, health insurance is almost a requirement. And so they usually give you three different plans. One, for example, is Bronze, which offers lower premiums, so lower monthly payments, but it gives you a high deductible. Now, a deductible is the amount that the insurance will pay before, or the amount of insurance that that you have to pay before the actual insurance company pays out. For example, with the Bronze plans, I've seen deductibles as high as $20,000, which means if you were in the hospital, if your bill was $100,000 of medical bills that came to you, your insurance will cover $80,000 of it, but you have to come up with the other $20,000. Okay, that's how deductibles work. So you'll have a high deductible in the Bronze plan, and it doesn't cover a lot. It has very low coverage. The Silver is kind of the middle of the road. Still has mid to low premiums, but a little bit high depending on which one you chose. But it still has a very high deductibles, sometimes between $10,000 and $20,000. But it does cover a little bit more. The other is a Gold plan, which has higher monthly payments, but it has a very low deductible or a lower deductible, which means that if, for example, I've seen some Gold deductibles at $100. So all you have to do is cover the first $100, and then they will give you they'll pay for the rest. Now, deductibles vary depending on the type of care that you're receiving. Some deductibles are lower if you're staying in the hospital, if you're staying overnight, and some deductibles are higher. Some deductibles are lower if you, in case that you're getting medications. Some deductibles for medications are higher or lower depending on the medication. So you have to look at that. Look at what kind of medications you need and that you're taking, and make sure that your plan that you're going with, call them, spend some time, don't be pressured, and make sure that what your plan is covering covers who you are. You don't want to spend money or get locked into something you don't want, okay? And Gold usually gives you the best coverage. Now, there is something called catastrophic insurance out there that only covers you in the event of a catastrophic health failure or accident, struck by lightning, or got in a very bad car accident that your PIP or PIP didn't cover, or that the other person's insurance didn't cover. Catastrophic insurance can cover that, but it does not cover regular visits to the doctor. It doesn't cover most medications. So if you feel like you're in good health, catastrophic insurance might be the way to go. But at the same time, you never know. So you got to be careful. The difference between, you'll see these things called an HMO, which is a health maintenance organization, or a PPO, preferred provider organization. Now, most Silver and Bronze plans only offer HMOs, or a health maintenance organization, which means that you have to have and maintain a primary care provider, all right, or a physician, depending on whatever term you use. And a primary care provider is the doctor that you see, that you register to see, and you can only see the primary care providers that are within that network. So if the plan will give you a list of doctors within the network, and those are the ones that you have to see or pick from. And then in order to go see a specialist, let's say you need to go see like a dermatologist or a ENT, an ears, nose, throat guy, if you have vertigo or something, issues there. If you have to see someone that's a specialist, you must get a letter of recommendation from your primary care physician or provider before you're able to see them. Now with a PPO, this is the biggest difference. You can see whoever you want, whenever you want, at any time you want. Okay, so that's the biggest difference with the PPO and the HMO. That's why you pay a little bit of a higher premium here. If you feel like you need to see a specialist, you can call and make an appointment, assuming that they take your whatever plan that you've chosen. There are several different companies out there, HAP, let's see, Blue Cross Blue Shield, all those kind of things. Next we have what's called life insurance. Life insurance is a super important insurance to have in your life. If you don't have it, you need to get it. If you are a dependent, your parents probably have it on you. All right. The idea here is to protect your family financially in case of a death. And when I say of a death, I don't specify here because you can and should have life insurance on your children. Not to make any kind of money, but in the case of your children's death, it's going to be very expensive to do a funeral, but also you're going to be in such a state that's going to be very difficult to return to work. And so you need some coverage there to maintain that that financial provision in the case of an emotional stress that would happen in the death of a child. So covering your child is very important. Never cover them in order to make, here you go, as an investment to make money on their death. That's not the idea. The idea is to cover in the event that something happens to them. All right. So you should never use life insurance as an investment, and that's the rule of thumb you should always have. And that's why we're going to go over whole life versus term, and why I think term is the much better option. So first of all, also the big idea is that in the event that a provider from your home, you or your spouse, passes away, you need to have an insurance policy that will cover your income. So you would say, let's say your income is $40,000 a year, you're going to need 10 times that amount. And the reason I say 10 times that amount is because you need to take that money, so you would need $400,000 worth of coverage. You're going to need to, your surviving spouse is going to need to take that money, that $400,000, and invest it in a fund or some sort of investment that will earn them at least that 10%, so that they're getting $40,000 a year of money, that income that you used to provide, they are going to get when you die. Okay, that's why you need at least 10 times the amount of your income. You need to cover those types of things. The whole idea of life insurance is to cover the financial gain that you have been providing your family. That's really what life insurance is about. It should not be used as an investment in case of your death. All it is to protect your family financially in the event that you die, your spouse dies, your children die, any of those kinds of things. God forbid, right? Now there are two types of insurance. There's whole life, or also known as permanent life insurance, and there's term life insurance. We're going to go over whole life because it's the more complicated one. And whole life insurance means you're paying premiums for the rest of the life of the investment. First off, you pay for a face value, just like term life. So the face value is the amount paid out in the event of your death, also called the death benefit. Okay, death benefit. So this will be paid out to your beneficiaries, and you can label your beneficiaries. It could be specific, very specific, including trusts. So the face value is the amount that's going to be paid out in the event of your death. Now, premiums are the amount that's paid to receive the death benefit. Now in whole life, you're also going to put some extra cash into what's called the savings portion, or the cash value portion that you'll receive interest on. Now that's the difference between whole life and term life, is they're going to put this away as kind of like a savings account on top of the amount that you would pay. And the face value is the amount that the company has to pay out in the event of your death, but the cash value is the amount that you've been earning, that you've been putting into this savings portion. Now here's the big issue I have with whole life. All right, one, the premiums are usually 10 to 12 times higher than premiums on term life, and let's say that you have a face value of $1 million, right? So you bought $1 million whole life insurance product, right? And you saved, let's say over the course of 25 years, you added to your cash value $500,000. Well, in the event that you die, the life insurance will not only cover will only have to cover $500,000 because you've already saved up $500,000, right? So what happens is they'll take the savings portion out to cover your premium, and then they'll pay out $500,000. Even though your face value was $1 million, what they do is they take the savings portion to help pay for the $1 million benefit. That's why it's scammy to me, right? Why do that? Why pay 12 to 10 times or 10 to 12 times more premium for this? And usually the investment isn't really worth it, although it is tax free. So it is pre-tax money, which means that it'll help you mitigate your tax burden. It's still not worth it because the money that you're going to save on the premiums and term life are going to you're going to take that money and invest that or get out of debt, whatever it is that you need to do. So avoid whole life, avoid permanent life. I don't care how they spin it to you. Never ever get whole life insurance. Okay, I used to sell insurance. I used to sell products like this, and I'm going to tell you, it is not worth the premiums. All right, especially since if all that money that you've been saving and putting in there does not go to your beneficiaries. It only goes to the life insurance company to help pay for the amount of your death. Even after you receive the face value, even after, let's say you saved up $1 million, well, then they don't have to pay you anything. You just take that $1 million, which it's silly. But if you saved up $1.5 million, they will not give you that $5. It's not worth the amount. Okay. Term life is simple. This is why I expect you to get term life. You pay a premium for a length of time, usually 10, 20, or 30 years, for a certain amount of money you would like to be given, or you would like given to your beneficiaries after your death. All right, that's it. So right now, my wife and I, we have about $300,000 each in coverage, and we pay very little. It's like $15 a month. All right, so I'm telling you, do not get whole life insurance. Just buy a 30-year term life plan for however many $1,000 that you need to in order to pay out the percent that you need. Okay, and that's really all you need to do in that case. And usually, by the time that you're old enough and that you've became that millionaire, or that you have several $100,000 in the bank, you won't even need term life insurance anymore, because you have enough money to help somebody in the event of your death. All right, that's all this is for. So these things should go away. If you're doing really well with your finances, these things should be something you don't need. All right, this is just for people who don't have the amount of money they need in the event of your death. Next, we have homeowners and renters insurance. The idea here is to protect you financially from unforeseen destruction to your home. That can be anything from, here we go, total loss of the home, which you only receive the appraised value, things inside your home due to flood, fire, mold, or other outside forces you weren't thinking about, damage to exterior of your home due to weather and other unforeseen circumstances. It'll cover that. But the homeowner's insurance is usually required by the mortgage company to maintain while you are in a mortgage with them. The reason is this: because since you are actually not technically the owner of your home when you have a mortgage, and the reason I say that is because if you stop paying them, they're going to foreclose on your home and take it back. So technically they own it, right? And what happens here is they also have a vested interest in you maintaining that home and being able to. That's why they require you to take homeowner insurance. What you'll see too is this: if working for the bank, I've seen checks where the insurance company will pay out to, first, since I sold mortgages, they'll pay out to the bank that I used to work for. So on the check it'll say I used to work for Flagstar Bank in Michigan, so it would say pay to the order of Flagstar Bank. I forget how they word it, but basically, and the homeowner. So in order to get this check given to the homeowner, it must first go through a process through Flagstar Bank. They have to approve of its usage, so they can't just cash. You can't just cash the check and go willy-nilly and go to the casinos, because it has to go through a process with the owner of the mortgage, and they got to make sure that it's getting, the people who are fixing your home are getting paid to fix your home. They will not just give you money for your homeowner's insurance. There's also renter's insurance, which covers things inside the home. It's a really cheap investment. You really should get this if you're a renter as well. Cover the stuff that's in your home in the case something happens outside of your home. Next, you have auto insurance. This one is a little lengthy, but I'm going to try to fly by it. The idea here is to protect you and other drivers financially in the event of a car accident or other damage to your car, for example, weather. They were paying out a lot of money when Hurricane Florence hit North Carolina. There's a couple of different insurance coverages that you need to be aware of. First off is liability coverage. This coverage is for the event of that the accident was determined to be your fault. It covers damages to the other vehicle. This is obviously required, but then this one's not required, but you should have it. Comprehensive coverage, especially if you have a new vehicle. This covers damage to your vehicle, including a total loss. This covers damage to your vehicle, including a total loss, which just happened to my wife and I recently. We had a RAV4, 2014 RAV4. It was the newest car we ever owned, and we bought it last year. We bought it in April of last year, and it was totaled in August of last year, so we only had a couple months. But luckily we had comprehensive coverage. It gave us a total loss. It didn't quite pay out the amount that we borrowed, but it was very close. And it's recommended on new cars, but also may be required if you owe money through a loan on the vehicle. Most lien holders, they make you have comprehensive insurance, okay? That's why it gets a little bit expensive to buy a new car. I don't recommend doing it. 3. PIP or no-fault insurance. This is actually 12 states require, including Michigan, where I used to be from. They require no-fault insurance. This covers the driver and passengers in the case of a bodily injury, no matter whose fault it is. That's why they call it no-fault insurance. The idea is that the two insurance companies handle this. You don't have to get in the middle of anything. There's no suing you. It's all covered by the insurance companies. But you pay a higher premium for that. There's uninsured and underinsured. Most states require this. This covers you financially if the other driver is uninsured or is severely underinsured. That happens. It is a requirement in most states that you drive with insurance, but it's not always the case that they do that, which happened to the one that totaled our car, and our uninsured insurance policy covered it, which is good because we didn't have to come up with any kind of deductibles, which is fantastic. Then you have what's called gap insurance. During a total loss of the vehicle, you may still come up short of the amount of the loan that you borrowed to purchase the car in the first place. What gap insurance does is it covers the amount exceeding the total loss. For example, if your loan was $20,000 for that nice car, but the insurance company will only give you $18,000 for your totaled vehicle, the gap insurance will cover that remaining $2,000. Gap insurance is usually given to you by the person who sold you the car through the company there, not usually through your insurance company, if that makes sense. Awesome. I hope this helped you. If you guys need anything, again, give me a call, email me, whatever it is that you need. I'm make sure to accommodate that for you. I love you guys. May God richly bless you, and we'll see you next time.